Okay, so something really crazy just happened with the stock market. And I'm not being dramatic. It actually broke down technically. So yesterday, the S&P 500 closed at 6,661, which means it slipped under a really important line called the 200-day moving average, which was sitting at 6,615. This hasn't happened in 214 trading days. That's almost an entire year, guys. Now, just so you know, the 200-day moving average is basically just the average price of stocks over the last 200 days of trading. When prices fall below that line, it's kind of like a red flag saying, hey, the good times in the market might actually be wrapping up. And financial experts are now saying that the war with Iran basically popped a giant money bubble that most regular people didn't even know was growing. Hey, I'm Elf of House Civil on YouTube. I've got a PhD in computer science, and I basically use data like a detective to find hidden patterns in world events and money stuff. Look, this is not me telling you what to do with your money, but we really need to talk about what's going on, because a war happening way over in the Middle East is literally shrinking people's retirement savings right now. So back in late January 2026, the S&P 500 hit its highest point ever, 6,978. The market was basically riding a giant wave of excitement around artificial intelligence. Big companies were throwing hundreds of billions of dollars into building data centers, buying powerful computer chips, and basically promising that AI was going to change absolutely everything. And investors totally believed them, so stock prices shot up to reflect all that hype and excitement. The tricky part, though, tech companies were priced so high that it only made sense if AI actually started making huge money really fast, like within just a few years. Then on February 28th, the war kicked off, and at first, surprise, surprise, the markets didn't really freak out. Wars have happened before, and markets have bounced back before. But this war is doing something different. It's messing with how the whole world gets its energy. Iran literally shut down the Strait of Hormuz, which is basically the pathway for 20% of the world's oil supply. Then Qatar's LNG gas facilities got hit and are going to be out of commission for years. We actually have a whole separate video breaking that down. Right now, oil is creeping up toward $110 a barrel. Energy prices in Europe have nearly doubled. And Defense Secretary Pete Hegseth straight up said there's no end date planned for this war. So here's how this war is actually breaking the markets right now. When oil gets expensive, literally everything gets more expensive, like shipping stuff, making stuff, heating your house, running electricity. That's called inflation. Now, the Federal Reserve, which is basically America's money referee, fights inflation by playing with interest rates. When inflation goes up, they raise rates to slow spending down. When inflation cools off, they cut rates so people borrow more and the economy grows faster. Coming into 2026, everyone on Wall Street was expecting the Fed to cut rates several times because inflation had been calming down. Lower rates mean cheaper loans, which helps companies expand and makes stocks go up. Then this war completely flipped the script. Energy prices are pushing inflation back up hard. The Fed held rates steady just this week and basically hinted maybe just one cut for all of 2026, and that's even a maybe. The 10-year Treasury yield, which is basically the interest rate the U.S. government pays when it borrows money, and it also pulls all other borrowing costs along with it, climbed up to 4.32%. And here's why that's really bad news for tech stocks specifically. These AI and tech companies are basically being valued on money they haven't even made yet, profits they're promising 5 or 10 years down the road. When interest rates are nice and low, those future profits feel really valuable today. But when rates climb up, those same future profits suddenly feel worth a lot less because you're applying a bigger discount to them. So when the market goes from expecting 3 rate cuts this year down to maybe 1, tech stocks take a serious beating. And that's exactly what's playing out. On Friday, the Dow dropped 443 points, the S&P fell 1.5%, and the Nasdaq slid down 2%. That makes 4 weeks in a row of losses, the longest losing streak in over a year. And when the market breaks below that 200-day moving average, computer trading programs automatically start selling, and big investment funds are forced to lower their risk, which pushes prices down even more. So now you're probably wondering, Okay, but how bad can this actually get? Goldman Sachs said in a really bad case scenario, the S&P 500 could fall all the way down to 5,400 this year. That's a 19% drop. And that's based on oil supply staying disrupted for a long time. Morgan Stanley said the index could hit 6,300 by April. And Ed Yardeni went on CNBC and said the war could cause a 10% to 15% correction. Now, what's a correction? It just means stocks drop 10% or more from their recent peak. Right now, the S&P is already down about 5.3% from that January high. Another 5% down, and we're officially in correction territory. A 20% drop would be called a bear market, basically the market going into full panic hibernation mode. We're not there yet, but falling below the 200-day moving average after 214 sessions above it is historically a really serious warning sign. If you want to learn how to spot economic changes before they become obvious and unavoidable, like this, go check out my book called Awake. It's all about sharpening your critical thinking when the real story is being hidden. It comes in ebook and audiobook. Subscribers get 10% off, and you can grab the first chapter completely free using the link in the description. The scary economic pattern showing up right now has a name: stagflation. It's basically the worst-case combo where inflation is high and the economy is barely growing at the same time. Rising energy costs push prices up everywhere, but those same high costs start hurting company profits, and people stop spending money, which slows the whole economy down. The Fed can't cut rates to help the economy grow because inflation is still too hot, but they also can't raise rates to beat inflation because that would crush economic growth even more, so they're basically stuck in the middle. And when the Fed is stuck and confused, markets go absolutely crazy with volatility. Tech stocks are especially exposed right now because the whole AI boom was built on the idea that borrowing money would stay really cheap. Giants like Nvidia, Microsoft, Google, and Meta have been dumping tens of billions of dollars into AI stuff. Data centers, chips, even power plants, all banking on the idea that borrowing stays affordable and AI delivers big returns soon. If borrowing stays expensive and a slowing economy means fewer people need AI services, all those massive investments start looking like really bad bets. Now, analysts are bringing up something called capex fatigue, which is basically the idea that companies might start pulling back on AI spending because the returns just aren't showing up fast enough. Bank of America actually warned that markets might be underestimating just how serious the Iran war risks really are. They put out a note saying that whether this market volatility turns into a full correction really depends on how long this disruption lasts, not just what the daily headlines say. The core question is whether the Iran conflict keeps energy and shipping costs elevated long enough to actually eat into company profits and drag stock prices down. And that really is the heart of the whole thing. If the war somehow wraps up next week and oil crashes back down to $70, the market will probably bounce back and recover. But if this drags on for months or even years, which honestly feels possible given that there's no planned end date and the Pentagon is already asking for $200 billion more, then energy stays expensive, inflation stays sticky, the Fed keeps rates high, company profits get squeezed, and the market has to reprice itself for a much uglier reality. Historically speaking, though, global crises don't usually destroy markets permanently. One big study looked at 40 major world events over 85 years and found the S&P 500 only lost about 0.9% in the first month, but then actually gained 3.5% over the following 6 months. But here's the thing, this particular crisis is hitting something the entire global economy depends on directly. Previous Middle East conflicts didn't shut down the Strait of Hormuz for weeks or knock out 70% of Qatar's LNG capacity for years. But this one unfortunately did both. The market right now is in a really delicate and fragile place, falling below the 200-day moving average after 214 straight sessions above. It tells you that the mindset of investors has genuinely shifted at a deep level. That massive excitement and optimism that pushed stocks to record highs back in January, it's just gone now. Analysts are calling the current mood buyer's remorse. The people who bought stocks near the top are now sitting on losses and starting to panic sell, and that creates a nasty loop where the selling causes more selling. Again, I want to be super clear. I'm not telling you to sell everything or go buy anything specific right now. This is purely about understanding the story of what's happening and why it's happening. The Iran war triggered an energy shock. That energy shock is forcing the Fed to keep rates high. Those high rates are slowly deflating the AI bubble that was honestly already getting a little stretched before any of this started. Whether this becomes a full-blown correction or tips into a bear market really comes down to how long energy prices stay elevated and whether companies can keep their earnings strong under all that pressure. If you want to see how all of this connects to the bigger picture of what's happening to America's economic power in the world, I made a video about the petrodollar system and why it's starting to fall apart. When the dollar stops being the main currency countries use for energy deals, the U.S. slowly loses its ability to borrow money on the cheap, and that whole process speeds up dramatically when wars disrupt energy markets and push countries to look for other options. Thank you all so much for watching. Go hit subscribe and I'll catch you in the next one.